What's up, Graham? It's Guys here, and you gotta pay close attention to what just happened. As of a few hours ago, the Federal Reserve decided to once again pause any rate cuts for the foreseeable future, and as a result, we are okay, in all seriousness, there's the concern that inflation is not going away anytime soon, because prices are no longer going down, jobless rates are slowly beginning to rise, and bubble talks are beginning to surface, with the stock market continually hitting new all-time record highs. But hey, at least on the bright side, you could still eat cereal for dinner to save some extra money. Right? No? No takers? Anyway, with the stock market pricing in fewer and slower rate cuts than before, let's discuss exactly what's happening, what the Federal Reserve just said, how this is going to impact you, and then finally, the implications this is about to have across everything, from stocks to real estate to Bitcoin to even how much you get paid in a savings account. Although before we go into that, I just want to say that I put a lot of work trying to get these videos out, usually within about an hour of when Jerome Powell goes live. So if you appreciate that, all I ask for in return is that you hit the like button and subscribe if you haven't done that already. It helps out tremendously, and as a thank you for doing that, I'll do my best to respond to as many of your comments as possible. So thank you guys so much, and now let's begin. Alright, so in terms of what's going on and why the Federal Reserve was just throwing a massive economic curveball, let's discuss the boogeyman of inflation. Look, it's no surprise the Federal Reserve's entire goal is just to get inflation to return back to their 2% target without sending the entire economy into a downward tailspin. But in terms of why they want 2% specifically, the answer is because they totally made it up. That's right, this entire 2% policy was the result of an offhand remark in the early 1990s from New Zealand, who said that they wanted to target 1% inflation, and then they rounded up to 2% to give a margin of error without much economic data behind it, and boom, the 2% policy was born. Now, in terms of when the United States adopted these policies, was it A, 1990, B, 2001, or C, 2012? Yeah, you can see where I'm going with this. It's C, 2012. Basically, this entire 2% policy is barely old enough to watch a PG-13 movie, and this is what's dictating our entire monetary cycle at this point. Although before we talk about just how unbelievable the entire inflation system really is, let's talk about the latest data, because it's surprising. See, when it comes to inflation data, there are two different ways to measure the price of goods and services, with the first being track the price of everything. As you can see, when you track the cost of all items, inflation did increase from 3.1 to 3.2% year over year, mainly driven higher by the fact that some categories just aren't coming down. In terms of these specifics, we could see that energy prices increased by 2.3% in the month of February, food stayed the exact same, increasing 0.4% month over month, which is the same as shelter, also up 0.4%, and finally services are up 0.5%, with transportation rising 1.4% in the last 30 days. But separate from that, we also have core CPI, which purposely excludes more volatile categories like food and energy, since those could be a bit more seasonal. And because of that, this has become the preferred measure of inflation to determine whether or not prices are coming down. Although in terms of what we saw, core CPI came in higher than expected at 0.4% month over month. The problem here is that for the most part, inflation isn't going away. Instead, some categories are only increasing, and since May of 2023, month over month, it's only trended higher. This has resulted in rate cut expectations being lowered significantly. And in a way, I guess this is something that Michael Burry previously warned about. He said in the past, inflation appears in spikes. It resolves, fools people, and then it comes back, with a chart showing that since the 1940s, inflation never just occurred once and then disappeared. It's also worth noting that even the White House did an analysis on inflation post-World War II, and they discovered that in almost every case, inflation took several years to normalize from the peak, and it's never flatlined within a year. So with a little bit more context, what we're seeing right now is completely normal, although we're not out of the woods quite yet, especially with everything going on with the stock market. Look, it's no surprise the overall market has been on an absolute tear, having already increased close to 10% this year alone, with the number of stocks hitting 52-week highs, hitting a 52-week high. In fact, I pointed this out back in January, but as you could see, in all but one case in 2007, all-time highs led to even more all-time highs 1 year later. And besides the 1960s and 1970s era of stagflation, 3, 5, and 10-year total returns were also positive. This suggests that based on history, the most likely outcome is that stocks continue to post record profits, or at least more likely than they are to go down. However, in terms of what's happening today, a lot of the recent momentum is all thanks to one simple term: AI, Like, just consider this. Bespoke analysts have reported that 67 stocks in the S&P 500 that are related to AI have surged by an average of 45% since the end of November of 2022 when the first iteration of ChatGPT was released. To make matters even more impressive, year to date, the average S&P 500 AI stock is up 3.7% compared to a gain of 1.1% for the non-AI stocks. In a way, this is worrying quite a lot of people who think that this is a sign that the market's in another spectacular bubble that could burst at any moment and then drag the entire market down with it. So is there truth to that? Well, we should first mention that in terms of the S&P 500, since it's weighted by market cap, the largest companies make up the biggest portion of the index. And because of that, just 7 stocks are responsible for the majority of those returns, with this graphic showing just how significant it really is. Now, in terms of specifics, Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla, also known as the Magnificent Seven, drove 87% of the world's stock market gains, in addition to making up 33% of the entire S&P 500. For reference, the last time we saw stock market dominance like this was back in the 1970s, 50 years ago. Back then they had a group called the Nifty 50, which included Polaroid, Sears, and Eastman Kodak, which drove the late 1960s bull market. After that, there were the 4 horsemen of Microsoft, Cisco, Oracle, and Intel that pushed the market higher during the tech boom. And even though we have a similar 7 today, in terms of whether or not we're in a bubble, experts seem to believe that no, we're not. As Forbes reported, unlike previous ideas that were fueled by rampant speculation of cheap money, today the leaders in the generative AI boom are large, mostly profitable companies. None of them are money-losing publicly traded stocks, and borrowing money to buy stocks and or fund companies is less of a factor. Now, to complicate those matters even further, of the Magnificent Seven, just Nvidia, Meta, and Microsoft are responsible for the majority of those gains. So when it really comes down to it, thank Nvidia and Mark Zuckerberg for delivering better results than Kate Middleton's Photoshop skills. Anyway, in terms of what this means for the rest of the market, good news. More than half the companies in the index are higher than they were when the S&P 500 reached its previous peak in January of 2022, suggesting that the rally has more room to run as those stocks begin to catch up, bolstered by greater optimism over the outlook for the economy. However, in fairness, the Wall Street Journal does reference some of the risks of today's market, even comparing it to a company like Cisco in the early 2000s. Back then, its price-to-earnings ratio of 126 in the year 2000 was clearly overblown, although the issue wasn't being in a bubble, but selling networking equipment to firms that were. When the digital rush ended, Cisco's profit and growth suddenly halved. This echoes the fact that, sure, companies are making money now, but should the market pull back, that could have some pretty big ripple effects throughout the entire economy. Although all of this really pales in comparison to the biggest talk of them all, Bitcoin. Since the beginning of January, prices have already gone up from $44,000 to $72,000. So what's going on? Well, it seems like Bitcoin is suffering from the same thing as the housing market, which is a lot of demand and not enough supply. And the one factor that's contributing to that upward pressure is the Bitcoin ETF. This works by essentially creating a publicly traded holding company that you could buy into that has exposure and tracks the price of Bitcoin without you actually having to go and physically buy Bitcoin yourself. Or basically, in really simple terms, you're buying into a fund, and that fund owns Bitcoin. So when you buy into the fund, you own a corresponding amount of that Bitcoin's value. Even though that somewhat defeats the purpose of Bitcoin of total ownership and control, you have to admit, it's very convenient, very easy, and evidently very popular. With ETF, you can now easily get direct exposure with Bitcoin in a Roth IRA, a 401k, an HSA, a stock market account, and it's way easier than buying and transferring to an external wallet yourself. Now, the downside, however, is that you're not actually going to own the Bitcoin yourself. You can't take direct custody of the Bitcoin, and most of them charge a 0.2 to 0.25% annual fee. But you pay for the convenience, and like I said earlier, that convenience is paying off a lot. In less than 2 months, BlackRock's ETF passed Michael Saylor's entire stockpile. In less than a week, the entire market saw a $2.7 billion inflow of capital. And with soon to be only 450 Bitcoins mined per day beginning in April, there might just not be enough Bitcoin to go around without the price going up. As Yahoo points out, since the beginning of February, ETFs have been purchasing an average of 3,500 to 4,300 coins each day. That's considerably more than the 900 coins being created each day by the Bitcoin network over the same period. Because of that, price predictions for Bitcoin have been all over the place. The asset manager of 3IQ says that his mid to high range price target for Bitcoin this year is between $160,000 and $180,000. Next year, it anticipates an eye-popping target of $350,000 to $400,000. $250,000. Another analyst also arrived at a $150,000 price target by assuming $10 billion inflows for 2024 and another $60 billion for 2025, while Cathie Wood believes that 1 million Bitcoin could happen around 2030. However, I will say that others are still quite skeptical, like Jamie Dimon, who compares Bitcoin with smoking. And at the end of the day, objectively, it's still very risky and highly volatile. We have already